Welcome back, guys. Today we are going to be talking about the interest rates in 2022 and how crazy things are getting. You want to stay tuned for this one. Good morning, good afternoon, and good evening. Welcome back to the Inside View Real Estate Podcast. I am your host, Josh Zuniga. I'm here with my amazing co-host, Carl Freund.
What's up, man?
And today we are going to be talking about what everybody wants to know. What is going on with these interest rates in 2022?
Dude, first and foremost, happy fucking birthday.
Oh, thank you. This is the guy that didn't show up.
Yeah, I'm the guy that, that's why I'm doing that now publicly.
Oh, yeah, okay. He's trying to make
trying
up
to
for
redeem
it. I get
just
it.
a little bit.
I get it.
But yeah, interest rates are fucked up.
Yeah, interest rates are going crazy. And obviously everybody knows it's going in the news and everybody's seeing that there's rates happening. What have we had? How many rates? How many rate increases? Major increases
we should probably distinguish that, right? So like when people are like, oh, we had 8 interest rate increases. Well,
give them the breakdown. I know you want to get into the nitty gritty of this stuff too. It's really good stuff.
So here's the economics of this thing. Yeah. And I have a degree, so I can kind of
pay attention to him, guys.
Halfway intelligently.
Yeah, he knows what he's talking about.
The federal funds rate is what the interest rate everybody's talking about, right? And it was 0 for a long time. And what the federal funds rate is the interest rate that the Federal Reserve will loan banks to cover the reserve requirement overnight, okay? And so Bank of America has a reserve requirement and call it $500 billion. They have to have 500 billion liquid assets. If they fall below that, they have to borrow the difference from the Federal Reserve overnight to meet that requirement. That is the interest rate that we're talking about. So what happens is interest rates, when they're low, banks like to loan out a lot more money and they make a little bit of a differential there. Mm-hmm. And so what happens is that they make money on the spread in between whatever money they're borrowing at, the interest rate they're borrowing at to the interest rate that you as a consumer pays, right? So if they're borrowing money at 1%, but they're loaning money at 6%, they're making 5% on somebody else's money.
That's their spread.
That's their spread. And so what we're seeing is that the federal funds rate is increasing so that it slows down the pace of lending, right? It slows the velocity of money down. And so that's the federal rate. Mortgage rates are really based off of the 10-year treasury, which is another bond. It's a bond, and mortgages are bonds. We should make that distinction. A mortgage is a bond. Okay. So, that's what we're looking at when we see like the actual mortgage rates is based on the 10-year note. And so fucking A, that's a long description.
That's the big description.
Yeah. That's a big description of that. But when you see, people talking about interest rates, that's really what they're talking about. The mortgage rate that they see is the federal funds rate has a little bit of an impact on it, but very slightly. It's more economic sentiment than anything. The economy's, the Fed is trying to slow down. Yeah. It's red hot right now. Yeah. Red hot. We got supply chain issues. We got massive inflation. And one of the ways to curtail inflation is to slow the economy down by slowing consumer demand down by pulling money out of the economy. And that's what they're doing, so that's what we're seeing right now. How
often do the interest rates actually change?
Every 10 minutes, every 5 minutes, instantly.
All the time.
Instantly. Yeah. And so look, when I was in the mortgage industry, and I was in the mortgage industry for almost a decade, we would get interest rate hikes 3 times a day, 4 times a day. Mm-hmm. And back in the day, they used to fax them over.
Oh my
goodness. So that's how old I am. Yeah. But you get a fax and you'd be like, oh shit, the interest rates jumped a half a point. Yeah. That's a big jump. And so what we saw in the past really 2 months is the interest rates on mortgages has been increasing at a faster rate than we've ever seen in the past 40 years. Mm-hmm. And so that's what people are kind of freaking out about. And it affects affordability in the housing market, right? Go to my YouTube video, like and subscribe, dang it. But I made a video about this about 2 years ago talking about this. And I was like, what is the craziness in the real estate market and why are we seeing massive appreciation? And it comes down to affordability because people buy homes based on what they can afford on a month. Same way people buy cars. Hey, I can afford $500 a month for a car. Bam, here's your lineup, right? You're getting, X, Y, or Z. Same thing with houses. Hey, I can afford $2,000 a month. Well, here's the band, here's the 400,000 to 450,000, right? But when the interest rates come down, that same 2,000 might now afford you a $500,000 house. And so that's why we saw that massive appreciation is because people can actually afford more because money is cheap. Yeah. So that leads me to another question. Like, do you foresee the buyer market slowing down?
Absolutely. It already has.
Yeah.
So just like case in point. So their interest rate from what it was in December to what it is now, the same person trying to qualify with the same credit score, same finances is probably going to pay anywhere from like $700 to $900 more I would say,
depending on
the average borrower than what they were, 4, almost 5 months ago. Ridiculous. Reason why I say that is because as an investor, I was able to get in a loan at 3.65, right? That same loan now is going to put me at 5.8. 5.8. That's insane.
It's insane.
For your average primary resident that's actually going to be living in the property, you're now in the 5s, where then you were in the 3.6s, maybe even lower, 3.5s. That makes a huge difference. The reason why I say that is because there's a huge, well, my parents own a credit reporting agency, a huge difference in how many mortgage applications were actually being pulled. And and for them,
dude, that's an important point to make right now.
Yeah.
Can you state that again? Because I don't know if people really understand the consequence of what you just said.
Okay. There's a dramatic decrease in loan applications that are being pulled since December until now.
Okay.
Yeah. So what is the effect of what that is? And you brought up affordability, right? Affordability is definitely a factor. The person that didn't buy in 2021 and is still considering in 2022, you may not even qualify for the house that you did qualify in December. And we're going to have another episode where they're going to talk about, some other things, even when it comes to like new builds about qualifying, but that is a huge thing. So if mortgage applications are down, what is that foreseeing as far as, the future within the real estate market itself? That's a big one too, right?
Well, yeah, I think you brought up another good point too. And so we should add on that. What we're seeing, we had a conversation kind of off screen, was if you're a seller, prospective seller, right? And you're in a house locked in at 2.875%. Let's call it a $600,000 house. And you're like, I want to upgrade to a $700,000 house. And now your new financing is going to be 5.25%, which is like almost double what you're paying now. Are you going to make that move? And the answer for a lot of people, I think, is going to be no. So what happens is that inventory is not available to the market anymore, right? Like what that turnover would have been is no longer available. And so it's going to reduce the supply of homes. And so when people are like, oh, I'm waiting for the crash, and Justin and I were just talking about this a minute ago, I don't know if there's going to be a crash, right? Because if you look at it, like it's supply and demand. If there's less supply, but demand is still strong, prices will probably remain the same, even though affordability is down. Because the seller's like, yeah, I don't need to sell. I'm not going to get off my 2.875%.
Yeah, right. As rightfully so.
So I had a really good conversation with Mike Burke from JFQ Lending this morning, literally an hour. This is my meeting right before this, about consumers and what they're doing. And what he said was very, very telling. And he says, we're up HELOCs by a lot. By a lot.
Yeah.
And that makes sense. And now I'm thinking about it from a consumer. I'm in my house, right? And I'm like, yeah, I don't feel like moving. What am I going to do? If my needs changed, I need a bigger house, I might do what a Josh Zuniga would do, would be put an addition on it. I might rehab it. I might put a pool in. I might upgrade it. I might, and you can pull the equity out, right? Because you have a ton of equity sitting in the house. It's all available to you. And relatively speaking, I don't want to be all doom and gloom and shit. When I started in the industry, my start rate on a first mortgage without pricing exceptions was 12.74%. Okay. And we could buy it down, and we can get rate exceptions down to like the 8s, like the high 8s. Then when 9/11 happened, we saw that massive drop, right? Because the Fed wanted to accelerate the economy. They made money cheap again. And we saw that 10-year yield come down. And that's when mortgage rates, dropped below 7. And we're like, holy shit, we're never going to see this again in our life. They hit 6.5%. I lost my freaking mind. Yeah. I'm like, oh my God, everybody's getting refied. You're getting a refi. I was like, Oprah, dude. I'm like, you're getting a refi. You're getting a refi. Everybody's getting a refi, and so, now we're talking about at some point, I don't think we're going to see 2.875% in our lifetimes without some kind of drastic economic pause, right? Like something drastic would have to happen in order for them to drop the rates again down that low.
Yeah. And to be clear of like, why would they actually drop the rates, so far, so significant to do what? If we do hit a recession, or if we do hit, some economic downturn, they drop the rates so they can start stimulating the economy again, get more people to buy. Same thing that we did in 2008. They did the same thing with the cars, right? They were giving all these incentives for you to get in.
Buyback.
Right.
Yeah.
It's like, was it cash for
clunkers?
Yeah, cash for clunkers. Same thing. So they're going to try and figure out what is going to be the new infrastructure, the new model that we're going to implement, for people to get more comfortable with the economy again. Yeah. Right now, everybody's talking about there's a recession. Well, case in point, guys, if there is going to be a recession, hey, be prepared for it, right? In some way, shape, or form. The reason why I say that, because when I look back on and I have foresight on what I saw in 2008, they were talking about the recession 6 months before it actually happened. And if they start marketing, oh yeah, there's a recession, here's all the information, here's all the data, then yeah, what's going to happen in the market? People are going to lock up, they're going to stop spending, the economy is going to slow down. And even here with what we have increased interest rates, like you were talking about, slowing down mortgage applications. We have, because of these interest rates, now you have less sellers coming into the market, so you have less supply, less demand, right?
That would make price equal.
Yeah. So now we're going to start leveling out, on things.
So you passed over something I think was really fundamentally important.
Yeah.
Perception creates reality.
Perception's everything, guys.
So if people are starting to perceive that the economy is slowing down, what do? They naturally pull back. What does that do? It slows down the economy.
Everything.
Yeah. So it's perception creates their reality. Mm-hmm. And, it's one of those things, I know I believe it, ask, believe, receive. People start thinking that, right? They're putting that thought out there. Well, the economy is going to slow down. And what happens? The economy is going to slow down.
Yeah.
And so when you see consumer sentiment or buyer sentiment change, then we will see drastic change in the market. And so in order to curtail inflation, we got to fix this fucked up supply chain. Got to do it, man. So I think that's one of the biggest things that we could do as the government can come in and help to fix that. They haven't done shit for it yet. But as soon as they can fix that stuff, then I think we'll see inflation tamper, and then I think we can get back to a normal economy.
Yeah. So let's end on a note of giving some valuable advice of what we would do if you were a buyer, and what would you do if you're a seller. So if you were a buyer in 2021 and you had to wait till 2022, or for whatever the reason is, you missed the boat. One, right? Interest rates have gone up significantly. Would you recommend that somebody still buy in today's market?
Depends on the situation.
Well, of course, everything is situational.
Relocation, you're probably going to want to buy in. If there's a situation where it's like, hey, look, I need to, get into a house soon, I'm going to say, hey, look for a rehab, something you can add value to.
Glad you said that. Yeah.
And so you can get into a house for, I'm going to say wholesale, because even wholesale is kind of retail at this point.
Yeah.
But maybe a little bit of a discount, and then you can get an FHA 203K streamline loan, which is a rehab loan, right? It allows you $35,000 in order to upgrade the property. That could be new appliances, it could be new electric, you could put, a new roof on it, and kind of dial it in the way that you want.
Yeah.
And so add value that way.
When you say value, you're going to have to search, guys, for a house that's obviously going to meet, and it's not in the greatest condition, but you can actually add, some more value to it in case of the repairs, right? So you may have to wait a little bit more, be more patient on exactly the property you're going to get into. It's not ideally what you would want. It's not turnkey, but the long-term investment and strategy to where you're going to get it for a better deal because the interest rates are higher, and you can obviously do the upgrades. You may come in at an appraisal that's higher than what you actually have it under contract for.
Yeah, that's true.
Which is great, right? Which is really, really good.
Yeah, and I think, big thing right now is just understanding that I think for me personally, and I'll put it on record publicly, October is going to be the inflection point. It's a big ship, and it takes a long time to turn a ship that big.
Yeah. Well, be ready, guys. We're going to have some more conversations about that here, coming before October.
Should you sell? Yeah.
Sellers. Should you sell? Like I said, situational. Case in point, I have a client right now. They want to sell their $1.4 million house, and they're asking us well, I want to sell, and I want to get all my equity, but then the houses that I'm looking at, I was like, oh, I want to pay cash for it. I was like, the houses that you want, the area you want to be in, you want to be closer to the kids, grandkids, you're at $800,000 with today's rates. Actually, they'd be paying cash, but somebody that's not paying cash, you have to really consider that. Is this a smart financial move? What I say, if you're looking to sell, make sure you're doing something with that money. All right. Don't just, I always don't like to put things all in one basket. I had a case in point. I had another conversation with an individual earlier today. He has $200,000 of equity in his property. Josh, what do I do? I was like, you have the ability to maybe pull some of that out, buy another property, make this one an Airbnb, make a long-term rental. He has the ability to make $1,000 a month on this property. Cash flow on this one, get another one, still raise out the appreciation on the second one, and then duplicate that process. Your money does no good sitting in the bank account. You need to find vehicles that are going to create additional cash flow for you. That's how you create wealth. That's how you create generational wealth. stop hoarding your cash. It's not doing anything for you except, maybe giving you some sense of security.
Yeah, it's devaluing. It's literally losing value.
Yeah.
Literally at 8 or 10% of your
Yeah. Right? So be smart with your money. Have the conversations with yourself, conversations with your family. Sit down and create a game plan. That's the biggest thing. Create a game plan. There's so many people out there that will watch all these videos, listen to all this content, listen to this podcast, and not do anything.
Execute.
Exactly.
Drive me nuts.
Yeah. So if you have to, talk to a lender, talk to an accountant, talk to one of us, a valid resource where we can get you on some framework that's going to satisfy your goals here within this year or maybe 5-10 years down into the future.
Nailed it.
Perfect. All right, guys, that's it for our episode today. Stay tuned for the next one. We can't wait to see you. Love you. Hey, guys, thank you for tuning in to today's episode. Make sure you like, comment, share, subscribe, do all the things. We want to continue to bring value to you every single episode. But until next time, see you on the inside.